Inflation, stagflation, crashing fiat and cryptocurrencies, damaging monetary policies, and now real estate. Here's everything you need to know about the state of affairs for Australian real estate. That's right, we're bringing information home today, boys and girls. And why are prices falling across the country, and how much will it fall by, and how can you make money out of this crash? And before we jump into the video, let's get you to smash the like button and subscribe and ring that notification bell, because, well, it's easy and it takes literally 2 seconds to do. And it'll just be a small gesture to not only support my channel, but take control of your own finances and investments in the future. With that out of the way, let's jump right into the video. Real estate has peaked in Australia since April, and it has already come 6% below its peak across the aggregate of capital cities around Australia. And this decline is happening fast across all major cities. Whilst places like Sunshine Coast and Gold Coast were the leader of the boom, they are now also leading the downturn. Gold Coast is down 4.8% in the last 3 months, and Sunshine Coast is down 6% in the last 3 months. And also Perth is also looking pretty sorry, with prices dropping the most since June 2020. And this downturn doesn't seem to want to stop. Pepper Money Treasurer Anthony Moore is pricing in 15% fall in prices. IFM Investors Executive Director Hiran Wanigasakira expects a 20% decline from peak to trough. And in case you've never heard of these super rich people, ANZ is predicting property prices will drop by up to 20% by the end of 2023. NAB also predicting 20 to 23% fall by the end of 2023. And the worst case scenario puts the Australian property market crashing a whopping and a surprisingly accurate 43.5%, according to Digital Finance Analytics, as they model what could happen to housing prices in the worst case scenario, indexed and numerically assessed against the rising interest rates. Now, speaking of interest rates, Australia has had one of the fastest growing interest rate hikes in its economic history, growing from 0.1 to 2.6% in just 6 short months. Here, you have to understand why this is happening. Energy prices have become significantly higher, which came from the reduced supply as a result of Ukraine. And because energy is a widely used commodity for producing many goods and services in Australia, it has led to a massive increase in inflation. And imports have become expensive due to imbalance in exchange rates, as the dollar became more expensive as a result of their quantitative tightening. And to battle this, Australia has been increasing its cash rate to reduce the supply of Australian dollars, to take back the imbalance of the currency rates, and to reduce the demand for items. And it seems like the rest of the world is following suit. UK is doing it, Hong Kong is doing it, and Canada is doing it. And so when Australia lifts their rates to 2.6%, then it will also squeeze mortgage holders. And it also impacts other parts of the economy as spending dries up across the board. This means there is reduced affordability in the market. Stockland CEO Andrew Whitson said that housing affordability is stretched at the moment due to the proportion of income going to mortgages. It's sitting in Melbourne in the mid-30s and more in Sydney in the low 40s, he said. Generally 30 to 35% is where we see that as being balanced. And looking here at the chart, that indeed seems to be the case, and mortgage payments have skyrocketed past the high of 1970s. And here we can see some cities have cracked above the 200% mark in mortgage payments to rent ratio, meaning the mortgage cost is double that of the cost of renting. And in cities like Sydney, almost all of the median full-time wages go into mortgage payments, and property prices range up to 16 times your annual wage. So with this alarming lack of affordability, it is certain that there is problem all around the Australian real estate market. But we haven't even gotten to the crazy part yet. Australia has had the highest household debt in the world except for Switzerland. And most Australian home loans are on variable interest rates, which exposes risks to future rate hikes. So as of October 2022, you can see that the change in mortgage payments have violently skyrocketed to levels higher than in the 70s, where mortgage payments have risen almost 40+% in just 1 year. We're also in a time of high property valuation, meaning the bubble might just be too big to keep on inflating. The combination of massive debt exposure with reduction in affordability is putting us in a dangerous territory to how Japan was in 1989 before their housing bubble popped. And as you can see, the value of residential land relative to GDP has beaten the level before the crash of Japan's property market. And it is important to note that this ratio carries the weight of other indicators such as population, production, debt or leverage, and valuation. At 3.5 times our annual GDP, the property sector is on the brink of a bubble pop should the scenario from Japan play out similarly here in Australia. Now, I do concede that Japan is a different market altogether, as there were different factors that impacted the Japanese property market, such as the Plaza Accord. However, this indicator does show that there is precedence on what ought to be considered as too big of a bubble. Okay, so what now then? How do we then make some money out of this situation? This is a question we all have been waiting for. First, I'm going to start with an interesting clothing line. I understand that not all of you are rich watching me on this channel, but I also know that not all of you are poor, and even the rich people need to know where to put their money, so here it goes. First thing I'll say is buy expensive mansions. A time will come in the near future where your money can expand the fastest in property should you invest in higher-end properties. The top end of the market fall the fastest and the most when the market retracts, and that could present some good opportunities down the track. As you can see, 3 months ago would have been the worst time to have bought something in the high end according to this chart. But it turns out that the most expensive part of the property market doesn't just fall hardest in bad times, it also rises the most in good times. And historically, the expensive houses have gone up more than the cheaper houses. But just understand that timing is everything if you're going to go and do something like this. And if you'd like further breakdown in this particular strategy, let me know in the comments below and I'll make a video on this. Secondly, I'd focus on yield. Make sure the property is yielding a high percentage to how much you pay in mortgage payments, meaning it pays higher rents than what you pay in mortgages. As you can see, the mortgage payments are going to rise. So if you are buying investment properties, whether it's commercial or residential, on paper thin yields, then you may need to dip into your own pocket to meet the serviceability of the loan attached to your property. Which leads to my third point, which is to hustle out the best deals. There's likely more properties are going to come out to the market, so there is going to be more options for you. They also say that you make money on property investments when you buy well, not when you sell well. You make your money on day one purchasing an asset below market values. If you're interested in knowing how this works further, then leave in the comments below and I'll make another video on this too. There's nothing better than putting in the work to get yourself the best deal so that you know you have made a smart move and paid under market value. And lastly, work. Things have become so much more expensive. Businesses are charging more, so become that business that charges more. Pay rise rates sit somewhere on 2.6% on average, while inflation has been historically 4.66% without counting for the current crazy high inflation rates. Don't be caught behind, guys. Your pay is not rising enough to meet inflation. Your wage alone is not enough. So start a hustle, offer a service or product, and pack in the cash to be able to invest when the bottom is in. And until then, invest in yourself to do the research and stay updated by smashing the like button and subscribing. And finally, thank me for tuning in.